Suppose that everyone has 59% bond value. So we know that the company issued at par. At par means the market rate is also 9%. 9%. Right? Because company itself, what is the concept of par? Par means when market rate is equal to coupon rate. So bond price is going to be the same 50,000, right? There is no premium, there is no discount. So what is the entry? Company receive cash. Cash is asset. Asset increase. Debit, right? And bonds payable is liability. Liability increase. Credit, right? Everyone. Lota, Kathleen, Florian, Dijodi, Nimesh, Coco, Ploy.
Understand, sir.
Good, good, good. Now, what will happen to the interest rate? So suppose Southwest Airlines has 50,000 of 9% bonds payable that mature in 5 years. Now, interest payments occur each January 1st and July 1st. So Southwest entry to record the first semi-annual interest payment is as follows. So we know that market rate is 9% and coupon rate is 9%. So what it has to do with the payment? So company is only committed to pay what is written on the certificate. So if in the market the rate is 10%, 11%, company has nothing to do with that. Company will only pay the 9% which is written on the face of the bond. So what is the annual interest rate? 9%. So company says they are paying semi-annual payments. So how we are going to calculate that? Simple. 50,000 multiplied by 9% multiplied by 6 by 12. Or you can say that 4.5 multiplied by 50,000. So this is the payment that is actual cash outflow from the pocket of the company that will go in the pockets of bond holders. Right? So what is the entry? This is interest expense. What is the entry? Interest expense to cash. Expense always debited. Cash decrease, asset decrease. Asset decrease, credit. So everyone, please participate. Nimesh, Kathleen, Coco, Dijodi, Lota, understand?
Yes.
Okay. Now the next payment that is going to be done on the next 31st of December. So 1st January or 31st of December is the same thing. Okay. So don't just get confused. So they are going to pay it in July and December. So from July to December, there is 6 months again. Right? Entry is the same, only amount is questionable. How we calculate that? So that is the, we calculate that one. Right? So in this case, when bonds are issued at par, so you see both payments are equal. Entry is the same. Whenever you pay interest, interest expense to cash, right? But you see interest expense to interest payable here. Why is that? In previous, we talked about here interest expense to cash, right? It is July 1st, right? So payment is on January 1st. So January 1st is going to be January 1st is going to be 2015, not 14. So that's why it is payable. So you see, it is 2015. 14. So 9%, 5 years. So each year, so they closes their, you can say, accounting period is from January to December. So they're closing in December, but their payments are in next year, January 1st. So on till December 31st, it is payable liability. On January 1st, you paid. So that's why it is on December 31st payable. Because on December 31st, we close the books, we make entries, we make financial statements. So that's why on December 31st, it is a liability, right? So when you actually pay on December 31st, on January 1st, then what is the entry? You decrease your liability. So liability decrease means debit. So interest payable to cash. Understand, guys? Since payments are on July and January, and our books closes on December. So the next payment, the semi-annual payment, the second semi-annual payment is going to be paid in next year. But remember the matching principle. Expense of that period should be matched or should be recorded in that period, right? So this is to be paid on 2015, but this expense belongs to 2014. So this is expensed in 2014. So see, interest expense. In previous, we recorded interest expense. And this will go to income statement. So it means this expense has already gone through the income statement of 2014. And only payment is going to be done on 2015. So that's why the cash and profit, they are not equal, right? They are not equal. If company says that they have earned 10,000 profit, so that doesn't mean that exactly there is a cash of 10,000 in their bank account. No, because there are some non-cash expenses as well. Plus there are some payments that we pay in next year, or maybe we paid from previous year's payments. So that doesn't mean that company, this 10,000 is backed by actual cash as well, right? So that's why we make cash flow statement, a separate statement. Okay, so what will happen when this bond expires? So bond is expiring at the maturity. Maturity is 2019. So what will happen when it matures? We pay back the money, right? We decrease our liability, we pay back the money. That's it. So liability decrease, cash decrease. Liability decrease debit, cash decrease credit. Right? There is no rocket science here. You just need to understand the concept, that's it. So when we pay back the whole maturity or the principal amount is 50,000. So liability decrease, cash decrease. Understand? Everyone? Kathleen, Coco, Lota, Dijodi, Ali?
Understood.
Yeah.
Good. Okay, so for discount, let's take a break for 10 minutes and try to digest what we have learned up till now. And then we start discussing discount and premium. Okay, because these two are a little bit related, but having opposite entries. Let's take a 10 minutes break. Okay, class, welcome back after the break. Okay, let's talk about the treatment or accounting treatment of the bonds payable which are issued at discount. So let's talk about the illustration here. So Southwest Airlines issued 100,000 of 9% 5-year bonds. What does it mean? It means total they have issued bonds worth of 100,000, and they are paying 9% interest, and maturity date is, or maturity years are 5. So when the market interest rate is 10, so from here you already know that the bond is issued at discount. Why? Because company is giving them 9% interest rate, market is giving 10%. So the price of the bond goes down, and hence the market price drops, and the Southwest received 96149, right? So how this value is calculated, there is a complete formula, and this is a finance topic, valuation of the money and all those stuff. So we are not going into that. Lucky we have already given the value here. So the concept is like that. You have given the value. So at the end of the 5-year, company will pay 100,000, but company receive 96.49. And what is the reason? The reason is because company is giving less interest rate than the market. Okay, but companies promise to pay after 5 years 100,000, right? So now how much company received the cash? Cash is 96149. So this is the cash. What is the liability that you will pay after bonds payable? Bonds payable is liability. Your liability is 100,000, but you receive 96149, right? So the difference is called the discount, right? Discount, what we learned is that discount has a debit balance. So discount will be written here. So what will be the entry? So let me clear this mess here. Entry would be cash discount to bonds payable. Hence the entry is complete. Debit is equal to credit, right? Remember, discount on the bonds, they have debit balance, right? Now what will happen with this debit balance? Because we know that on year basis, the value will increase to 100,000, right? How? Because we are dividing this discount into 5 years, and each year it is added to the bond value here, until the end it becomes 100,000. So let's just talk about that. So here we will learn the concept how interest expense and interest payments, they are different. We just talk about the valuation, or sorry, treatment of bonds payable at par. So we didn't see any kind of two interest rates. We just talk about, okay, interest payment, that's it. So now we will learn about that. Interest payment is something different. Interest expense is different, right? So let's just talk about this. So how it is shown on the balance sheet? Under the long-term liability, bonds payable, less discount, and this is the value, right? So this is shown on the balance sheet as if there is a premium, so you would be also adding, there's going to be plus here, so there's going to be a premium here as well. Let's just, but premium we'll talk about in coming slides if we have time. Otherwise, we will talk about in